You're watching silver do something it hasn't done in decades, and most investors are completely missing it. While everyone's distracted by the noise in traditional markets, a technical pattern just formed that historically precedes massive price moves. And I'm not talking about a 10 or 20% gain. I'm talking about the kind of move that can reshape portfolios. Let me show you exactly what's happening right now, why this pattern is so significant, and what the smart money is doing about it. Silver just carved out what technical analysts call a double bottom formation. Now, if you're not familiar with chart patterns, stay with me because this is critical. A double bottom happens when price tests a support level twice, fails to break below it both times, and then reverses higher. It's one of the most reliable reversal patterns in technical analysis because it shows you something profound about market psychology. Think about what's actually happening during this formation. Price drops to a certain level and buyers step in aggressively. Then price rallies, pulls back, and tests that same level again. And once again, buyers defend it with force. That second test is the key. It tells you that level isn't just random support. It's a line in the sand where serious capital is willing to deploy. The pattern we're seeing in silver right now tested support around the $29 to $30 range twice over recent months. Each time, the metal bounced hard. And now, price has broken above the neckline of this formation, which is the technical trigger that confirms the pattern. When that happens, the measured move target, calculated by taking the depth of the pattern and projecting it upward, suggests significantly higher prices ahead. But here's what makes this particular setup so compelling. It's not happening in isolation. This double bottom is forming against a backdrop of fundamental drivers that are unlike anything we've seen in modern markets. Let's start with supply and demand dynamics, because this is where the story gets really interesting. Silver mine production has been essentially flat for years. We're talking about a commodity where new supply isn't keeping pace with growing industrial demand. And that industrial demand is exploding in ways most people don't realize. Solar panel manufacturing alone is consuming silver at unprecedented rates. Each solar panel requires about 20 grams of silver, and global solar installations are accelerating as countries race toward renewable energy targets. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure build-out requires silver in virtually every component. We're in the early innings of an industrial revolution that runs on silver, and the supply side can't keep up. Now layer in investment demand. Exchange-traded funds backed by physical silver have seen massive inflows. Retail investors are buying physical coins and bars at rates that have mints struggling to keep up with orders. And here's the kicker. Institutional investors are starting to wake up to silver's potential. You've got to understand the relationship between gold and silver to appreciate what's happening. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has historically averaged around 60 to 1. There have been periods where it spiked much higher, like during the 2020 crisis when it hit 120 to 1. But over the long term, that ratio tends to revert to its historical mean. Right now, even with silver's recent strength, the ratio suggests silver is still undervalued relative to gold, and when that ratio starts compressing, when silver begins catching up to gold's performance, the moves can be explosive. We saw this in 2011 when silver went from $18 to nearly $50 in a matter of months. We saw it in 1980 when silver hit $50 during the Hunt brothers era. These weren't gradual moves. They were parabolic surges driven by a combination of technical breakouts and fundamental scarcity. The double bottom pattern we're seeing now is forming at a time when these fundamental drivers are aligning. It's not just a chart pattern. It's a technical confirmation of what the fundamentals are already telling us. Let me tell you about what's happening in the physical market, because this is where things get really fascinating. There's a growing disconnect between paper silver and physical silver. The COMEX, where silver futures trade, shows one price. But try to buy large quantities of physical silver, and you'll often pay a significant premium above that spot price. Those premiums tell you something crucial. There's more demand for physical metal than there is available supply at current prices. Dealers are reporting delays in delivery. Mints are rationing production. And meanwhile, the paper market continues to trade massive volumes that dwarf the actual physical silver available. It's a system that works until it doesn't. And when the physical market finally forces a repricing, the moves can be violent. Central banks add another layer to this story. While they're primarily focused on gold, their actions have profound implications for silver. When central banks buy gold aggressively, as they've been doing at record levels, it validates precious metals as monetary assets. It signals concern about fiat currency stability. And that concern doesn't stop at gold. It flows into silver, especially as investors look for more affordable ways to gain precious metals exposure. Think about the geopolitical backdrop we're operating in. De-dollarization is accelerating. Countries are settling trade in currencies other than the dollar. The BRICS nations are exploring alternatives to dollar-based systems. Debt levels in developed economies are at historic highs with no clear path to resolution. These aren't fringe concerns anymore. They're mainstream discussions among policymakers and institutional investors. In that environment, hard assets become increasingly attractive. And silver offers something unique. It's both an industrial metal and a monetary metal. It has intrinsic value from its industrial applications, but it also serves as a store of value and inflation hedge. That dual nature makes it particularly compelling in the current environment. Now, let me address something important for those of you thinking about how to position for this. If you're sitting on retirement accounts, there are ways to gain precious metals exposure within those tax-advantaged structures. I've put together a comprehensive guide on how gold IRAs work, covering the mechanics of getting physical precious metals into retirement accounts without triggering tax penalties. You'll find that in the description below. It's worth reviewing if you have $100,000 or more in retirement savings and you're thinking about diversification into hard assets. Back to the technical setup, because there's more to this story. The double bottom isn't the only bullish pattern forming in silver. Look at the longer-term chart, and you'll see silver has been building a massive base over the past few years. It's been consolidating, digesting previous gains, and setting up for what could be the next major leg higher. Volume patterns support this view. During the formation of the double bottom, volume contracted on the declines and expanded on the rallies. That's exactly what you want to see. It tells you selling pressure is diminishing while buying interest is increasing. When price broke above the neckline of the pattern, volume surged. That's confirmation that the breakout is real, not a false move. Momentum indicators are turning bullish across multiple time frames. The relative strength index is showing strength without being overbought. Moving averages are aligning in bullish configurations. The technical picture is about as clean as it gets for a major move higher. But let's talk about what could go wrong, because no trade is without risk. The primary risk to this setup would be a major deflationary shock that crushes commodity prices across the board. If we saw a severe economic contraction that destroyed industrial demand, silver would likely suffer in the near term. However, even in that scenario, the monetary aspects of silver would likely provide support as investors flee to safe havens. Another risk is intervention in the paper markets. We've seen periods where large short positions in silver futures have capped price rallies. The concentrated nature of the futures market means a few large players can influence price action, at least temporarily. But here's the thing. Those interventions become increasingly difficult to maintain when physical demand is strong. Eventually, the physical market wins. The opportunity here isn't just about the next few months, it's about positioning for a multi-year trend that's being driven by structural changes in the global economy. The transition to renewable energy isn't going away. The push for electric vehicles is accelerating. 5G and future communication technologies will require more silver, not less. These are secular trends that will drive demand for years to come. On the supply side, there's no quick fix. You can't just turn on new silver production overnight. It takes years to develop new mines. Existing mines are facing rising costs and declining ore grades. The easy silver has already been mined. What's left is more expensive to extract, which puts a floor under prices even in weak markets. The investment case for silver extends beyond just price appreciation. Silver offers portfolio diversification benefits that are particularly valuable in the current environment. It has low correlation to traditional financial assets like stocks and bonds. When those markets struggle, silver often performs well. That negative correlation is exactly what you want in a diversification asset. There's also the inflation hedge aspect. With central banks having expanded their balance sheets dramatically and governments running massive deficits, inflation concerns remain elevated. Silver, like gold, tends to perform well in inflationary environments. It's a tangible asset that can't be printed or created out of thin air. In a world of unlimited fiat currency creation, that scarcity has value. Let me paint a picture of what a major move in silver looks like, because if you haven't experienced one, it's hard to imagine. In 2010 and early 2011, silver went from around $18 per ounce to nearly $50. That's a 177% gain in roughly 8 months. It wasn't a steady climb. There were pullbacks and consolidations along the way. But the overall trajectory was unmistakably higher, driven by a combination of investment demand, industrial consumption, and technical momentum. What's interesting about that 2011 move is what preceded it. Silver had been building a base for months, forming patterns that looked similar to what we're seeing now. When it finally broke out, the move was explosive. Early investors who recognized the setup and positioned accordingly saw life-changing returns. We're potentially at a similar juncture now. The base has been built. The fundamental drivers are in place. The technical pattern has formed and confirmed. The question is whether you're positioned to benefit from what comes next. Think about the broader context of where we are in the commodity cycle. Commodities have been in a bear market or sideways consolidation for over a decade. That's an unusually long period of underperformance relative to financial assets. Historically, these cycles eventually reverse. When they do, the moves can be dramatic as capital rotates from overvalued financial assets into undervalued real assets. Silver, trading at a fraction of its inflation-adjusted all-time high from 1980, represents one of the most compelling value propositions in the commodity space. Even if it just returned to its previous nominal high of $50, that would represent significant upside from current levels. And if it were to reach its inflation-adjusted high, we'd be talking about prices well into triple digits. The smart money is already positioning. Look at what mining companies are doing. They're not expanding production aggressively despite higher prices. Why? Because they understand the cost structure and the challenges of bringing new supply online. They're being disciplined, which means supply constraints will persist. Look at what sovereign wealth funds and pension funds are doing. They're increasing allocations to real assets, including precious metals. These are sophisticated investors with long time horizons and deep research capabilities. They're not chasing momentum. They're positioning for structural trends they see developing over years and decades. The retail investor has been largely absent from this market. Compared to the frenzy we saw in 2011, current retail participation is muted. That's actually bullish, because it means there's a massive pool of potential buyers who haven't yet entered the market. When they do, when silver starts making headlines and capturing mainstream attention, the buying pressure could be intense. Social media and modern communication have changed how quickly sentiment can shift. A move in silver that captures attention can go viral in ways that weren't possible in previous cycles. That could accelerate and amplify price moves beyond what we've seen historically. There's also the factor of younger investors who are increasingly skeptical of traditional financial systems. They've seen currency debasement, they've witnessed financial crises, and they're looking for alternatives. Some have turned to cryptocurrencies, but there's a growing recognition that physical precious metals offer something crypto can't: tangible value that exists outside the digital realm and doesn't depend on electricity or internet connectivity. The double bottom pattern in silver is a technical signal, but it's confirming a fundamental story that's been building for years. It's telling us that the market has found a floor, that buyers are willing to defend that level aggressively, and that the path of least resistance is now higher. When you combine that technical setup with the supply constraints, the industrial demand growth, the monetary uncertainty, and the undervaluation relative to gold and to its own historical levels, you get a compelling case for significant upside potential. This isn't about trying to time a perfect entry or exit. It's about recognizing a major trend in its early stages and positioning accordingly. The investors who do well in these moves aren't the ones who wait for confirmation after confirmation. They're the ones who recognize the setup, understand the drivers, and have the conviction to act while the opportunity is still in front of them. The double bottom in silver is that opportunity. It's a rare technical pattern forming at a time when fundamentals are aligning in ways we haven't seen in over a decade. The question isn't whether silver will move higher. The question is whether you'll be positioned when it does.